Hey everyone, George here. I know a lot of my construction contractor clients have significant crypto holdings. So I thought that it may be a good idea to go over tax strategies related to cryptocurrencies and any year-end tax planning with respect to cryptos. So if you had a big year with big jobs, big profits, you're in a high tax bracket, we're going to go over 6 crypto strategies between today's episode and tomorrow's episode that you could possibly put into play to bring down your overall tax bill. So let's get started. So anytime you sell crypto or use it to buy something, you're effectively triggering a taxable event. So what we're going to go over today, so you're not stuck with high taxes, are IRS compliant legal strategies, 6 of them in particular that we're going to cover that will help lower your tax bill with respect to crypto. So first one on the list is what's called tax gain harvesting. And it's an incredibly powerful strategy for high income years. The idea behind it is that if you expect your income to be higher next year and for your crypto to keep climbing, you can sell the crypto now, realize the gain this year, and then buy it back immediately. This basically resets your tax basis, to today's prices. So when you do sell it in the future, your cost basis is at a much higher point. So again, this is effective only when you expect next year to have significantly more income, compared to this year. This usually works when number one, either your business is growing significantly, and number two, if you had usually a startup year. So this year you only had partial, let's say only 3 to 6 months of income. So either way, if you're on the up and up, tax gain harvesting is probably something you're going to want to look into. So let's look at an example down here. So if you, let's say you bought Bitcoin at $20,000 cost basis, and let's just say today it's $110,000. You sell it, you realize a $90,000 long-term capital gain, which is at better rates. You immediately repurchase at $110,000. So now your new cost basis is $110,000. So how that works is for next year, if it goes to $140,000 and you were to sell it then, your taxable gain then next year would only be $30,000. And the other thing that really works with this strategy is that since the IRS treats crypto as property, the wash sale rules do not apply. So you don't have that 30-day window where they effectively disregard that sale repurchase. Now, when would you not implement this strategy? Number one, if you're going to be in a lower tax bracket next year, so if let's say the pipeline is a little dry and not too many jobs coming through, if you don't anticipate too much income next year, this is not a good strategy to implement. Number two, if you have short-term capital gains as a result of it, that's not going to put you at a better tax bracket. So this usually is recommended when you're able to utilize long-term capital gains, meaning you held the positions for at least 1 year. So again, tax gain harvesting is something you want to do if your income is climbing and you expect significantly more income next year, and to possibly even liquidate some positions next year. Number 2 strategy is tax loss harvesting. So maybe you don't have losses in Bitcoin this year, it hit all-time highs, you're well above your original cost basis, but you might have losses in altcoins, NFTs, DeFi, or any positions you bought on a hype cycle. If that's the case, selling any positions before the year end would let you utilize those losses against any capital gains and offset up to $3,000 against ordinary income. And there is a way around that $3,000 limitation for offset. That's going to be the last strategy we cover tomorrow. However, again, the general rule is that you can offset up to $3,000 of capital losses against ordinary income. However, you could offset those capital losses against other capital gains in the year, which is the idea of tax loss harvesting. So the idea here is that you're selling any coins, NFTs, tokens, whatever, in a loss position to use those losses to offset capital gains in the current year, and then you're repurchasing it back again, basically same day, next day. And the beauty with crypto is that the IRS views it as property, so the wash sale rules don't apply. So you can sell that coin, token, DeFi, NFT, whatever, in a loss position, take those losses to offset it against your gains, and repurchase the same positions again next minute, next hour, next day, and basically be in the same exact position again, and now you've been able to utilize those losses against your gains. And the final strategy we're going to cover today, strategy number 3, is gifting crypto to family members. In 2025, you can gift up to $19,000 to somebody and $38,000 between a spouse and yourself without the need to file a gift tax return or trigger any taxable income of any sort on their end, as in on the recipient's end. So again, gifting crypto is not taxable to you, not taxable to the recipient, and does not trigger any sort of tax return, like gift tax return filing or anything like that. So the only catch with this is that the recipient assumes your cost basis. So if you gifted $10,000 of Bitcoin to your granddaughter and you had originally bought that Bitcoin at $1,500, your granddaughter's cost basis is now $1,500. So if she were to go sell it in the future, any taxable gain or loss would be up against that $1,500 cost basis. This is a good estate planning move, especially for, people with kids or grandkids, and they want to be able to pass down value without actually triggering any tax. So that's 3 strategies we covered today: tax gain harvesting, tax loss harvesting, and gifting crypto to family members. I don't want to overwhelm you with too much in one episode. So the next 3 we're going to go over in tomorrow's episode, and the last one being the most powerful one, assuming that you do qualify for it. I hope you found this helpful. Click like, subscribe, turn on notifications for any updates, and hope to see you in the next one.